Steve Baker here on the call with us, founder of VendorSage. He helps organizations buy, manage, and adopt software more effectively. Steve's focus is really on turning SaaS sprawl into streamlined, value-driven stacks that enable businesses to do more with less, which ties directly into Brett, your comment around more and more companies being under pressure to do more with less. So sounds like this is going to be a great fit for those experiencing that. Now, the reason why we wanted to get Steve onto the session was that we've actually worked with Steve with a number of customers in the past, and we've been able to help them achieve significant cost savings on their licensing. And so I just thought that, Steve's a great person to get in front of other customers of ours, where we specialize in, Atlassian. Steve looks at the whole stack across the board, and I think he's got a lot to offer. So I just really thought this could be a very valuable session for you all. So what I'll do is I'll hand over in a second for Steve to introduce himself a bit more thoroughly. But before I do, just on Q&A, just continue using the chat section or the comment section there. If you think of anything during Steve's presentation that you want to ask, pop it in there, and we'll circle back to that at the end. Otherwise, once Steve finishes up, we will have a dedicated Q&A time, and I'll pass on those questions to Steve to answer. So yeah, with that, Steve, I'll hand over to you, and thanks for joining us.
Awesome. Yeah, thanks so much for having me, Darren. Sounds like we've already covered off a couple of really near and dear points to my heart with the last couple of shows that you've gone through. So really good to hear. Hopefully not too much repeat in what I put together, because I did hear a little bit of what I will be going through today. I've tried to keep this session more focused on like insider tips and tricks and where I see the biggest gaps. I'll try not to bore you all to death, but yeah, we'll see how we go. Cool. Awesome. So just a little bit of a background as to who we are, how we got here. That is me in lovely San Francisco, probably the only person crazy enough to be wearing shorts on purpose there. I think that was February or March 2020, right as the world started to get a little bit topsy-turvy. I had just joined the Big Blue Cloud, and I was going for the last in-person company kickoff and indoctrination, as they probably more accurately like to describe them as, and yeah, getting my journey underway. And really, I guess, the world that is enterprise software sales. So in my time at Salesforce, I got to work with Series A through D companies, and I learned three things really, and it was that businesses didn't do a very good job of buying, managing, and adopting software. I'm going to try not to bore you all to death with numbers and stats today, but I am a numbers and stats guy. So some of the things I learned in my time there was that 70% of software implementations failed to do what they set out to. We also saw a massive chunk of software spend getting wasted at around 35%. Of all the buyers, we found that 88% of them were overpaying. And then on average, businesses have only around 30% visibility over their SaaS footprint. And then as a last point, we found that 80% of SaaS applications went unmanaged within organizations. So take from that what you will. The core behind all of that is that there's a visibility issue. So that sort of spawned the idea of VendorSage, which we started working on probably in 2023, I think was when we first put pen to paper. Since then, we've gone on to really focus on helping companies do a couple of things, and that's to move smarter, faster, basically helping them figure out how to be a little bit more frictionless when it comes to how they buy, manage, and adopt software. We work with most of New Zealand's top startups. We're starting to move higher up into the mid-market space now, but most of our customers typically tend to be really fast growing tech-enabled orgs. So why have a chat about this at all today? This is probably not super new to anybody on the call, but software's not going anywhere. We're seeing adoption, and we've seen adoption explode in rapid succession for the last 5 years. By 2026, 85% of all business apps will be SaaS-based. That's done by a Gartner study. And then also by that same period of time, public cloud spend will exceed 45% of all enterprise IT spend. It's going to keep becoming more and more of a problem. It's basically the gist of it. And so tech-enabled businesses average out 1.5 paid apps per employee. They average out visibility. It's somewhere between 35 to 40% across their apps. 80% of those apps aren't fully managed. That number, I think, has actually creeped up a bit since we last did that study. I think with the advent of AI apps, it's probably closer to 90 now. And then, yeah, the big one that most businesses are really looking at is that number of spend that is wasted. It's a huge, huge amount. So when we first really want to approach this, we need to figure out where the opportunities typically sit. For us, the three main areas we find for opportunities in cost optimization are really aligned behind that lack of visibility and alignment, and they are an underutilized tool set or license set, large overlaps in functionality, and really poor procurement processes. Try and say that one fast 3 times. So a little bit about how we got here. That 2020 shove when the whole world turns itself upside down and we found ourselves sat at home, onset a massive drive in digital transformation. We saw that in 2021 there was a huge amount of capital that came into the tech space, and it really changed the way businesses started distributing themselves. It really changed the way decision makers were making their choices. We saw decentralized buying and shadow IT really started to create overlaps and fragmentation. We saw limited governance and inconsistent workflows that created data silos and reporting gaps. And the SaaS vendors themselves really took advantage of this. They still are. AI is a really classic example of that. AI is not so much an innovation for you, it's an innovation for how businesses take themselves to market. And they're really capitalizing on that quite well. So yeah, they're the ones really winning out of all of this. They don't really care so long as you keep paying. So the opportunity, is it cost optimization? Yes, absolutely. You have the opportunity to optimize somewhere between 20 to 40% of every dollar you spend on software. But I think it's bigger than that. I think the businesses that do a better job with how they buy, manage, and adopt software, they are the ones that are going to end up winning. If we remove the lens of trying to see what we can do to slow ourselves down or what we can do to implement guards or measures, tech is probably, arguably, got the highest propensity for impact to velocity on a business. So we see digital first companies are 65% more likely to achieve their goals, and 59% of businesses experience profit of at least 11% due to their digital transformation initiatives. So I'm going to talk a little about, I've got 3 playbooks to share with you. Again, you might have seen some of these already. I'll talk to what I know, and I'll keep them at a pretty high level. But the first playbook I really wanted to walk through was rationalization. So the thing that I think that a lot of businesses really struggle with is they really don't take the time to understand themselves. They don't break down silos between orgs, and they don't make decisions with a very clear picture. I have this notion that we have goals as businesses. We hire people to help us execute on those goals, and then we go and we manage them, and we check to see how they're doing on how we're moving towards executing on those goals. Software is no different from people. We should have job descriptions for software. We should have an understanding of where the software belongs and is it doing what it's supposed to be doing. But for some reason, we behave and treat it very reactively. And so that's where the real basis of, I guess, this first playbook starts to spool up in my mind. So there's a couple of key steps, but it really centers around creating an org chart for your software. That begins with mapping tools and categories. So really simple stuff, just making sure that there's buckets you can put tools into, assigning job descriptions and OKRs and KPIs to each tool, sunsetting tools that you can't put a job description to, and then starting a process where you're tracking return on investment, running quarterly reviews, similar to how you do with an employee. This is a massive one. I think a lot of businesses probably do bits of this, but getting visibility over your entire stack, what you have, how much it costs, who has access to it, how often they're using it, and most importantly, what they're using it for, and if it's doing that, that's the nugget. That's where you really want to get to. We've seen businesses embark on this process on their own, like where they'll go and try and do this figuring out how information moves to and from and around the business in different workflows. It's an exercise that I've yet to see be done very well internally and on your own. If it's not your only thing that you're doing, it's going to be hard. I spoke to a COO the other day who said he spent 3 months doing this, just mapping how information moved around in the business. So one of the things that we've seen that typically tends to work quite well here is to align yourself with a professional services firm that can come in and help you do some of that initial mapping, not specifically like just to see whether or not a piece of tech fits into the business, but do we actually understand how information is moving around? Have we identified the gaps? Do we know what's working and what's not working? Giving yourself a blueprint on where you're at right now, and then starting to try and figure out how you align technology, for lack of a better word, to what it is you're trying to do as a business, and then constantly tracking whether or not you're moving towards that. So playbook 2, now that you know where you're at, you can then start to think about what the opportunities are for things like consolidating. So one of the things we've seen happen again and again and again with most of the businesses we typically tend to work with is because of that easy distribution model of SaaS, the number of apps creeps up really, really quickly. Whether or not they cost a lot of money, what they end up doing is actually diluting I guess the effectiveness and the velocity of whatever it is businesses are typically trying to achieve on. If you have a whole bunch of tools that are doing a whole bunch of things, you're not actually doing a lot most of the time. They are jobless, and you might end up with 3 or 4 tools overlapping on certain categories, which is very common. We see that a lot, especially for the businesses where we see that number 1.5x, almost 30 to 40 tools on average. Typically just have no roles or responsibilities in function whatsoever. So what we typically tend to recommend to most of our customers is to start to think of a couple of core platforms to really start to consolidate and build a vision on. So understanding where you can get to, making sure that's sort of really aligned with where the business is going. I think one of the things that I've also seen work quite well in this space is when you take a bit of a design thinking approach. So rather than just going functionality, starting to really think about like how your customer moves around in different parts of your business, and starting to think about what you can do to tailor and flex and build your tech strategy to align with that. It typically yields, once you've got to this point, an opportunity to go and find those redundant tools and consolidate them onto these bigger platforms. There's a lot of different ways, and it's not just license based. You don't always need to buy a license. So often we find that most of our customers aren't even remotely equipped to understand like the full level of availability that most of the licenses on these bigger platforms will give you access to. So we see, by going through an exercise typically with a partner, if they can be agnostic, great. If they're vendor specific, that's not a problem at all either. But the point is to try and go and start to map capability and build a bit of a plan and figure out what you can do to get some alignment and direction and a roadmap with these bigger vendors. There needs to be a plan with them. If they become stagnant, they'll very quickly become shelved. They'll start to fall out of sync with probably where you're headed. You need constantly to invest in them like you would in an employee. And the key thing we keep going back to is validating fit. You should, on a quarterly basis, and no later than that, be going back to going, does this have a purpose and a place in our roadmap? Does it align to where we're going as a business? Does it fit into our tech strategy? Feedback mechanisms are lacking. Like you often will find that businesses, when they are gathering feedback from users, there's not normally a point to what we find anyway. They battle to actually validate what they're testing, whether or not a tool is there to do. So they'll gather information that is like, did you like this tool? Or, are you happy with it? And that's not really but it's not enough to really give you any sort of firepower or ammunition to take into a deciding conversation on whether or not you want to keep investing in the tool. So aligning the questions and the validation criteria based on the job description, OKRs and KPIs for the tool is a really big one, I think. And it typically tends to work quite well for most of our customers once they get to that point. I always go back to this. If a tool isn't doing what it's supposed to, it doesn't matter how good a deal you get for it. It doesn't matter if you're paying a good price. Yeah, it needs to have fit. So jumping onto the third playbook, this is a big one for me. I think one of the easiest ways I can explain why this matters most is it's not a muscle that really exists in a lot of orgs, and even procurement teams haven't really got this right because, yeah, traditionally procuring software is a little bit of an afterthought, and I think because of how fast software has, I guess, proliferated through and grown in terms of budgets, we haven't really caught up to how we enable our teams to do this well yet. It's not enough to just be on top of, contracts and where renewals are at. You've got to start thinking about things a little bit more proactively. So just a couple of quick tips from me. The first is a very obvious one. The first thing we do with all of our customers, we want to turn the auto renew off. A really big one is getting well out in front of renewals. This is for a number of reasons. The first being that if the vendor isn't where you need it to be, and you come into a conversation a month out or 2 months out, that's not enough time to figure out a viable alternative or to give yourself time to land soft if you do need to make changes to the commercial arrangements. We see so often, 15 days out, someone will come to us and say, can you help us with this? And you've passed the lapse point for when you can exit the contract. The vendor holds all of the leverage effectively, and the best thing you can do at that point is just try and ask and get on their good graces. Agreeing on a renewal strategy, that's a really big one. A lot of our customers, when they first get to us, renewals are approached very reactively. I think that's also because a lot of the time those JDs, OKRs, and KPIs aren't agreed on or shared internally. So having stakeholders involved in this that are across that makes it a lot easier to align on a renewal strategy. One of the things we see, because we engage with vendors at any given point in time, we've got 50 plus negotiations on the go. You can go to a vendor and ask for a better price, even if you know through price benchmarks what a good price looks like. But if you're going in and just saying, I want a better price, it's gonna get spat back in your face realistically. But if you can go in with the why rather than just the how much, it tends to make a real difference. Gathering user feedback as well. You can build your own leverage in a renewal, going back and saying it's not where it's supposed to be. This is what the usage data we have looks like. If you go and speak to your account executive or renewals manager as you're approaching a renewal, and you ask for a review on how things are gone, they're going to tell you that they're going to give you the rose-tinted version. Everything's going to look like it's going great from their perspective because that's what they want you to believe. You need the data to back yourself up, and you need to be informed on where you're going. And then the last one is a really simple one. Just aiming for sign-off at least 60 days before the renewals are due for any contract over 100K. We found that if you can get that right, you typically tend to actually save somewhere between 10 to 15% more than you normally would, another 30 days closer to that number. So yeah, those proactive outreaches are a really, really big one. Talking about new purchases, going back to the JD piece, know where something's going to fit. We see so many purchases that just have no purpose whatsoever. It's the shiny new thing. I think I get asked on a daily basis, what AI should we be looking at? Which is probably the bane of my existence, because if they end up buying based on that as the reason they want to do something, it will churn. It's just a matter of time. So yeah, figuring out first and foremost where it's going to fit, what it's going to do, why it's going to do it, and what good is going to look like, and then constantly checking in as you work your way through that. That's really what you want to do as a first port of call. Having a clearly defined buying process as well, understanding what budgets are actually going to look like. Being realistic and transparent with the vendors is a big one. I think that for me is something I've found really typically tends to help quite nicely. If you can go in and be upfront and transparent with what the process is going to look like from your end, you start to get a little bit more control in it, and you also don't end up with any ambiguity, which helps the vendors sort of set expectations on their side and typically makes for a much faster, smoother buying process as well. Using price benchmarks if you have them, bit of an unfair advantage for us. We have a couple of $100 million worth of them across thousands of vendors. So it typically tends to help if you do have something to reference it against. If you don't, ask around. You probably are in an ecosystem where you could speak to people, and you'd be really surprised with how open most of them are to just having a general conversation around pricing as well. And my personal favorite, speak to customers they don't connect you with. A vendor will always connect you to someone who's happy. That's not who you want to speak with. You want to speak with just general run-of-the-mill, the average. You don't need to necessarily speak with someone who's unhappy because you don't know what was involved in that process. But yeah, getting put in touch with someone that is going to give you true, honest, unbiased feedback is a really big one. Onto some lucky dip tips. So these are a couple of the tips that we typically tend to deploy, and they work quite well. At the moment, an example of one of these is currency. So the specific vendor I'm going to reference is HubSpot. They have a current list price of $240 AUD per month for their Sales Hub Enterprise license. But the exact same list price in USD is $150, which works out to be $15 AUD cheaper per license. So once a HubSpot rep has quoted you in, let's say hypothetically speaking, they give you a 50% discount, they have to honor that rate if you're still purchasing within the same country and you can move around between currencies. So yeah, you're potentially getting yourself access to somewhere between another 5 to 10% in discounting, just figuring out whether or not you're paying in the right currency at that point in time. Resellers, this is a really big one we typically tend to use a lot. Understanding what resellers exist within an ecosystem and whether or not dealing with them will get you a better deal than going direct to the vendor. New Zealand and Australia, Australia not so much anymore, but New Zealand is a satellite country to most major software vendors. They don't really care. And that's a tough pill to swallow, but they typically tend to outsource a lot of their go-to-market activity to resellers. And because of that, they'll incentivize those resellers to go and do better deals than maybe what you would be able to get access to than typically dealing with an offshore account executive. So yeah, we see some really good results by building up strong relationships with resellers and not being afraid to sort of approach multiple as well. The other one, I think I've referenced this already, but turning off auto renew is such a big one. 75% of software contracts are all on auto renew. Auto renews result in 15% worse commercial outcomes. That's not up for debate. So it's a simple one. If you turn it off, someone's going to call you. They're going to have a conversation and you can negotiate. It takes 1 second to do it, aside from the login part. So yeah, I strongly recommend you do that. So on some apps, turning off auto renew will pop. It'll actually trigger it'll trigger some form of incentive sometimes for you to actually turn it back on or for a conversation to begin. So yeah, really recommend that one. Uplift caps. So when you're negotiating in a new purchase, a lot of the time, one of the red lines we typically tend to position is to try and cap whatever a price increase could look like at renewal. Very seldom gets asked, but it's not a hard one to put in there at all. Even if you cap it at 5%, some vendors have unlimited. So, you know, at your renewal, they could raise the price as much as they wanted. You can very, very often get this put in there. And even if you get it down at somewhere between 1 to 5%, it's some good price protection and guarantee without having to commit to a multi-year agreement. I think a call out on that as well is like some of the purchasing behaviors we're seeing. We're seeing a lot less multi-year commitments happening at the moment. I would say each year for the last 2 years, 3-year commitments have dropped by about 20%. So there's a definite shift in that. So something like an uplift cap will give you that same sort of certainty without so much of the needing to commit to longer agreements. Know the vendor, not they vendor. So that's a really big one as well. Understanding the vendors that you're buying from, I think, is a really important one to get right. Knowing when their financial periods are, knowing what their reps are incentivized on. I think I heard, Darren, you mentioned someone talked about, like, developing a good relationship with your rep. That was a huge one. Like when I was at Salesforce as an account executive, the thing that really, like, the amount of subjectivity that comes into pricing, you could literally, and 20% could go one way or the other, and it's purely based on how an account executive feels. But also behind that is understanding what drives them to make the choices they do. So yeah, really do take the time to get to understand your key vendors, and it will pay itself off in dividends. Timing's everything. I find a lot as well. Like if you wait long enough and you align yourself to a financial period with a vendor, the incentives and the flexibility that they will push towards, especially Salesforce. 31 January on Salesforce is the craziest time. I would hate to be in revenue ops within their team, because I think they process something like 1,000 deals in a day or something like that. It's just nuts. But yeah, that's really it. I guess from a perspective of the tips that I have, the takeaways that I have for you, just if we can recap and all you want to take away from this, this can be boiled down into 4 bits, and that for me is understanding your business and where the gaps are for tech, creating an org chart for your software and aligning it on purpose and fit, consolidating, really thinking about investing in those core tools, gathering the feedback and listening to your users. There is no bigger piece of advice that I could give. Software has to be doing something, and it has to be doing it for the people using it. So listen to the people using it. And being mindful and proactive about your procurement. You should negotiate with the why, not the how much. And that's it, I think.
Awesome. Thank you, Steve. That was great. There's a lot to digest there. Let's go into some Q&A. We've got one here from Jimmy. I think this was in relation to creating that org chart and doing the rationalization piece, asking if there's any off-the-shelf templates for that type of road mapping that people can use to get started.
We're building it. We're building it on our platform at VendorSage, but I can give you a template based on like sort of how we're framing it up ourselves. Yeah, we are building software specifically to do this though.
Yeah, awesome, cool. All right, there you go, Jimmy. Reach out if you want to get kick started. We don't have anything else in the chat right now, but jump in, anyone else with questions. In the meantime, I had a couple listed here that I thought would be interesting to raise with you, Steve. These were there's a couple here from previous sessions that I would be really interested to get your take on. So one of them, and I think you've sort of touched on these points already. One of the questions was, I believe it was in Rick's session, he talked a lot about so that similar concept around consolidating onto fewer sort of core products. And one of the questions that came up was, what is the flip side? What is the risk in doing that in terms of, does that not give fewer of software vendors more leverage around like price increases? And, does it make it harder to then move off of those platforms if you feel like you need to, because you're no longer happy down the road? So how would you sort of approach that?
Yeah, I think there definitely is risk to going through a big consolidation process. But to my point prior to getting to the point where you have consolidated is the fit piece, aligning on what tools are supposed to be doing, direction, and making sure that they're actually going to be able to do that. That's a really big piece, I think. A lot of businesses will get sold on a vision and a dream, and then not actually figure out where they are at in that point of time. A really good one of our customers spoke about the other day, that they're the owner of Salesforce within their business, and to their knowledge, things were going great. They heard a water cooler conversation happening about how 3 people just absolutely hated its guts. Go figure with Salesforce. But yeah, I think what's missing a lot of the time is you don't actually have a grasp on where things are at for the tool. User sentiment to the side, where is it actually going? One of the biggest things I think I battled with as an account executive, and why I ultimately ended up going on to start VendorSage, was there was no direction so much of the time. And direction might sit with one person, and then that person leaves and that's it, gone. So a big part, like, as to why we're thinking of tech strategy the way we are, is tech strategy should actually be collaborative. You should break down the doors and the silos so that you can get unanimous agreement on where things should be headed. At the very least, once you get to that point, you can actually start to go, well, are we all aligned on where this is going before we make an investment and do consolidate all of this into one place? Rather than what you typically tend to have is one person making a bet. That person leaves once the bet's sort of paid off, and then we go and follow this cycle.
Yeah, awesome. That's great. Thank you. We've got a question here from George. What is the easiest way to map out all of our SaaS tools? Do you have any recommendations for an approach?
We can help with that. We've built a platform that helps businesses understand what tools they have, how much they cost, who has access to them, how often they're using them, and then we go into the rationalization off the back of that as well. The manual approach to doing that is really taking the time and reverse engineering from spend, I think. So you can go and have a look at, or you can probably go and ask your finance team to give you a breakdown of where the spend is coming from, and then start to build up through the back of that, maybe like what your vendor portfolio is looking like, and then manually assigning them and using something like a spreadsheet if you don't have a vendor management system in place. Yeah, that would be my best bet, I think.
Awesome. Thank you. And thanks for the question, George. Stu's asked here, now this one I believe was a similar one, came up in a previous session and you have touched on it. So some vendors will allow multi-year terms, of course, as you were sort of talking about earlier. Do you have a best practice around multi-years? Do you like multi-years? Do you not like them? Pros and cons? Is there specific situations in which you would use them versus not?
Yeah, it depends. It depends on the size and the impact of, I guess, what you're procuring. So if it's a new purchase and it's under a specific threshold and it has low impact, I'll typically recommend going for smaller, so month to month, even if possible at that point. If that's not an option and you're forced, I really would strongly recommend against anything longer than a single year commit if it's the first time engaging with that vendor and it's unproven. And then at renewal, we would look to do something like, now that we've proved it out, it's doing what we're happy with, we'll probably look to, if it does make sense for the long-term fit of what our tech strategy is looking like, then a multi-year is something we take into consideration. With renewals, and specifically for those core vendors, especially one where we do have a roadmap and an understanding of where the tool is headed, then absolutely multi-year should be tabled. Like I said, we're starting to see a drop-off in anything longer than 3 years. The main driving factor behind that is where tech roadmaps are headed. So most of the purchasers I speak with are really reluctant to commit to anything more than 3 years because they just don't know where technology is going to be, where SaaS is going to be, where AI is going to be. Even in the next 2 years, people are starting to get iffy about 2 years and go, we'll actually take the hit on price because we just want to, we'll just see if our requirements change in that period of time.
Yeah, awesome. Yeah, that's great. Thank you. And We've got a question here from Glenn. So from your experience, what approaches worked best for a reseller to win new customers licensing business?
Yeah, that's a good question. I think being really transparent is the biggest one. Like, people buy trust. So helping them understand, by helping your customer understand what mistakes businesses typically make when they go through these processes, helping them get an understanding of what to expect through the buying process as well. If you go and speak to this vendor, you'll probably see these things happen. You probably front foot some stuff as well for them. Yeah, I find that really does a really good job with building trust. Like, a lot of the time, the buyer doesn't know how to buy correctly, and so if you can help them do that piece, even if you aren't the cheapest and the cheapest option in front of them, I think that trust that it builds does a really good job on that front.
Awesome, that's great, thank you. And we've got a question here from Brett. So he said, I often chat with portfolio owners / C-level who are responsible for tooling platforms, but have very little time to understand which tools do what, where the overlaps are, and how they should approach consolidation. How does VendorSage approach this, and how long does it take? Sorry, how long does it take, and what would a customer take away from this?
Yeah,
That's
so
yeah.
it's it ties into what we're building at the moment with tech strategy. So in our current form, it's a bit of a manual process. We go through and we understand spend, we understand who has access, and then we understand high-level capability. Where we're going is working downwards from business goals, bucketing and rationalizing, and then starting to understand, based on, in the customer's language anyway, where each tool fits. So think of it like a job description. You might have experimental pieces that sit underneath that, but there should be core tools aligned to each OKR, each part of the journey for their customer, front office, back office, so on and so forth. And really starting to try and get top-down alignment. Yeah, that's sort of the way we like to think about that. How long does that process take? We still haven't fully finished that up yet. We're using, we've figured out a couple of ways to speed this process up, because one of the things we've figured out is that obviously businesses don't have a lot of time to be focusing on this stuff. So we can make quite a few assumptions based on the model of the business, and we can go and do some pre-population based on what we understand about those vendors as well. And we can do a pretty good job of actually starting to guess where tools would actually fit into their tech stack, and then we pass it back on to them for confirmation. Yeah. That process, we're hoping we could finish up in less than 2 to 3 weeks. So to be able to say, this is where every tool belongs in your stack, this is what it's doing, this is what utilization and adoption looks like. And then from there on out, it's probably going to be a bit of a backwards and forwards process with each customer to then start going, what do the OKRs for the tool look like? Where are the KPIs? How are we tracking towards them? So on and so forth.
Cool. Yeah, I mean, 2 to 3 weeks is a lot quicker than. How long did you say that CIO that you were working with spent on it? 3 months or 6 months?
3 months, yeah.
Yeah,
3 months, and then the moment he was done, it was out of date, right? Because it's a static document at that point.
Yeah, absolutely. Awesome. We've got one more here from Jimmy. Can you talk about vendor risk management versus cost management? Some believe having less eggs in one basket is better for risk management. What are your thoughts?
I think this is where, like, having a little bit of a diversified approach to your portfolio makes sense. Again, I'm going to go back to those job descriptions and tracking where things are at from a sentiment and health perspective. We find that if there is room for experimentation and making sure that a vendor is the right fit, that's not a bad thing at all. You should have in a category and let's call it a job description in a specific space. The core tool that's locked in doing that. The question you want to be asking is, could it be doing it better? Are we moving it towards doing it better? And even being able to come in at a renewal and say, well, we found these tools, from an experimental perspective that are showing some great preliminary results. What can we do to either progress our roadmap and our stand on where we're at with you to replicate some of the early wins and success we've seen with these experimental tools? that's a really good way to de-risk a little bit. I think like you don't want to get to a point where you overly consolidate yourself, because you will end up in a position eventually where a switch is going to be required. But yeah, the typical rule of thumb is to probably try and boil it down to like 3 to 5 sort of really key vendors, and that's a nice place to be, I think.
Yeah, cool. That sounds good. And you said this was the bane of your existence, but we can't end the session without talking about AI. So I know from our experience, our team are having a lot of conversations with customers who are having a really hard time understanding, which AI tool does, like, essentially the same problem you're talking about more broadly, but specifically with AI. Where is the overlap? Which AI tools should they invest in? Every vendor's coming out with their own AI tool. How are you approaching those conversations at the moment?
Well, all the same mistakes we made with buying SaaS, we're making with AI, and the problem is that AI has easier distribution than SaaS. So that number I showed you at the start, I think it was 70% of software implementations fail to do what they set out to do. AI is 90%. Because it's easier to get AI in. But we're doing the exact same thing, which is we don't know what we're buying this for. The question is at the start there, what tools should we be looking at? And that's the wrong question. It's what should we be working on? That's what businesses don't figure out very well. You should be taking a really strong look at where the problems really exist and working backwards from that. If AI happens to be the right solution to plug that gap, by all means, really define what you're going to buy, really align with it on a vendor and put a strong plan together to test that it can do that and then implement that, which is exactly what you should do with SaaS as well. But what I see so often is you buy AI and then go and try and figure out what to solve with it, because every AI platform can do everything, and that's a recipe for it does nothing, basically.
Yeah, absolutely. There's always a bit of that fear built in around being left behind, right? Which might be
for sure.
Buying decisions.
I think so. But really being clear on like success criteria for like, does this do what we want it to do? I distinctively remember probably a couple of months back, I sat down in a large procurement with I think it was Notion, and they were evaluating Notion Enterprise, and the rep said, "Look at how many people we've had log in and use the tool." And it was like, "What have they done? What were they testing it against?" And he couldn't tell us, right? And he's like, "Oh, we've had this many searches." I was like, "And what was the outcome of the searches? What's the point in us buying this if we don't know what it is that this is going to do?" I'm not trying to fearmonger or say that we shouldn't be investing into AI. It has, massive propensity for impact. It's just the same mistakes are being made. So getting really clear about what you want it to do and a plan to actually get it implemented and embedded into the org is what you should be focusing on first.
Awesome. Love that. Nice, clear message. Thank you, Steve. I think that's all the questions we had. Yeah, thanks again, Steve. I will say for everyone on the call, there will be a recording of the session. So keep an eye out for the recording that'll come through in your email, and you can share that around with anyone who you think would have really enjoyed this and couldn't make it. The other thing I did want to mention before we jump off is, for anyone here based in Sydney, we have the finale of the Strategic Software event series as an in-person event in Sydney next month. So there's, I'll drop actually a link to that in the chat here now. So yeah, please sign up or share that around with anyone that you know that's in Sydney that would enjoy this. We're also going to be doing a recap of Atlassian's Team 25 announcements from Team Europe. But otherwise, yeah, thank you so much again for your time, Steve. Really appreciate it. Yeah, I got a lot out of that, and I'm sure everyone else did as well. So yeah, thanks everyone. Yeah,
thank you. Yeah, thanks for having me. I really appreciate it.
Awesome. Cheers, Steve.